Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. My guest today is Jason Sedawie. Jason is the Senior Portfolio Manager at Spaceship, and in today's conversation we cover Jason's investing style, some of his mental models in investing, and his where the world is going approach to investing. So please enjoy my conversation with Jason Sedawie. Jason, thank you so much for being here today, but maybe just to introduce yourself for listeners who may not know you, could you just give a quick rundown of maybe your background and how you ended up to where you are today?
Yeah, sure, Kalani, and thanks for having me. It's great to be on. So my name's Jason Sedawie, and I work for Spaceship, and we're a fintech based in Sydney. We have around 1.2 billion funds under management and 200,000 customers, and we basically have two products. We started out in superannuation, and we've got what we call Voyager, which is a savings and investment app, and so it's split between those two products. And I guess for me, I started out as a chartered accountant. You can still see my glasses, just as a badge of honor for getting through that. And then my background was in boutique funds management, so with Australian equities and then global equities. And for me, I just really like Spaceship's mission of trying to make investing easy, and it's something near and dear to my heart because I think the best way to build wealth is to own things. And, it's very difficult to own a property and to start a business. Starting a podcast is hard, but we can all, very easily buy a share, and, we can piggyback on some of the great wealth builders and businesses out there. So for me, just totally aligned with the mission of trying to make investing more easy and accessible and get people started thinking about investing.
Yeah, totally agree. And like you said, the capital required to get started investing is so much lower than compared to a house or sale or anything. In terms of your interest in investing, obviously you started with accounting. What started with your interest in maybe some early influences? Like, why did it appeal to you?
Yeah, I'm not sure how true it is today, but investing's still not really taught at school. And so I grew up not really knowing much about it. My parents are in small business, and you name it, they've owned lots of random businesses. So I grew up in that environment. And it probably wasn't till I was in maybe year 10 or 11 at school, and I had my first job at Hungry Jack's, and you know what it's like with your first job. You go, oh, wow, this is the real world. You really earn a couple of dollars per hour. I got to be more careful with my money. And just that confluence of factors along with the Billabong IPO, because I grew up surfing, just got me really interested going, wow, I can invest in businesses and leverage my money and not have to put in the hours, but have someone work for me 24/7 around the world. And Billabong had that potential at the time because it was still very Australian, going over to the US. And that really opened up my eyes to this whole perspective. Oh, what is the share market? Like, what is that? It's basically businesses that you can buy. And so you go to the supermarket to buy groceries, you go to the stock market to buy businesses. And every now and again they go on sale. So for me, it just all lined up. I'm like, wow, this is a great little hobby. This is something that really interests me. And it's just been a journey of continuous learning ever since.
Do you think your temperament has always suited investing, or was that something that maybe you've developed along the way?
I actually think my initial temperament was really good, but then like most people, you get caught up in the market and you think, oh, I'm a genius. I'm going to start buying like being in Perth. I can imagine just the resource stock, the mining stock stories that you hear. You hear about the ones that make 100 times your money, but it's a bit like the lottery, and it's not really a consistent way of doing it. Like if you really want to, you can put a small percentage. Not personal advice, but it's not a consistent long-term way of investing. And I think my initial approach of buying what you know, buying what you understand, thinking about it as a business was actually correct. And then the sort of everything, like the whole industry is not structured to drive your return. Like, you think about the business news, they're there to drive ratings. Think about stockbrokers. They're there to get you to trade. And fund managers, most of them are there to build a business. It's sort of linked to your returns, but they're trying to build a business. So everyone's not exactly aligned with your long-term wealth building. And I think that's something to not stray from, just that whole incentive structure that a lot of people are trying to get you to trade, to be active, because that's how they make money. But that's not necessarily how you can make a lot of money. So it was actually, it's a journey of back to the future for me in a lot of ways.
Is there anything else maybe you wished you learned earlier along your investment journey? Like, was there any painful lessons along the way, or?
I think you've got your podcast name right, Compounding Curiosity. I think that for me is a big thing. And going back to school, or uni, there are no classes about decision making. And I think decision making is such an important thing. And Warren Buffett's right-hand man, Charlie Munger, talks a lot about mental models. And I think that's really a really helpful way to learn and think about investing. And how does that relate to investing? Well, your investment returns will reflect your decision making and mental models. And the more mental models, or I call them lenses, will help you improve your decision making. Like, for example, like a psychologist, if you put on the psychologist lens, they'll think about things in terms of incentives and psychology, whereas like an engineer, you put on their glasses, they'll think about things in terms of systems, redundancies. And so I guess what I would try to do is just to learn the basics of each field. It's difficult, but just having that different perspective will help you make better decisions and help you make better investments. And I guess the benefit of good decision making doesn't just help investing; it helps a lot of things, like choosing what you want to do in life. What am I going to wear today? Just thinking probabilities and just building up these mental models, because I think they're really key to helping you learn. And to go on a bit, it helps me as an investor, because what I'm actually doing is people give me their hard-earned money and I invest it, but I give it to management teams and they invest. So I'm actually like subcontracting out the decisions a little bit. And what I want to see is management decision-making frameworks around capital allocation, how they think about problems, how they think about competition, how they think about supply and demand. And so for me, some of the biggest learnings have been from like just watching some of the best business people invest. Like, we all follow the great investors like Warren Buffett, etc. But like just seeing the framework that Jeff Bezos uses and Reed Hastings has used at Netflix, it's that has been a big learning for me.
In terms of your edge, how do you see your edge? Because you've got a background with startups, fund management, accounting. Like, how do you view your background that gives you a unique view on markets? Like, how do you view your edge when competing against obviously everyone else in the market?
That sounds like something lame I said on LinkedIn. That's probably where you got it from, isn't it?
Yeah, basically. Yeah.
Like, be careful what you say on social media. I would say it's the different lenses that you have. And going back to this is the mental model example. Like, you can read and learn things, but sometimes you have to experience things. And I think working for me at Spaceship has helped me become a better investor. Just watching how our engineers think about problems. Like, I'm not a big whiteboard person, but they'll go to town on a whiteboard and break down problems, and it's a work of art to me. And then we also have VC investors and how they think about it from a team point of view and problem solving. And so for me, it's just helped me double down on things that you read about, you learn about, but then when you really experience it, it's really ingrained. And I think Spaceship is interesting because we're not just a traditional fund manager, we're a fintech, and because of those people there. And so I try and structure it, thinking as a way to be more long term. So, thinking about over a 3 to 5 year period, not a 1 year period, because a lot of people are very, short term orientated because of those structures. So we try and structure everything as a super fund as well. We're trying to take the best of each sort of, super fund industry, funds management, fintech, engineering, and just putting it all together and putting together a process that can, over time, create hopefully better decisions and environment that gets you to those better decisions, which hopefully should lead to better returns if it all works out.
Yeah. So with regards to Spaceship, could you maybe explain a little bit about the where the world is going approach and like your approach to investing?
Yeah, sure. So where the world is going is basically we look for products or services that are becoming more relevant over time. So think about like streaming, TV streaming, or cloud computing. And there's 4 steps we look for. And so we look for trends. We're looking for companies that are building new habits or solving problems in a new way. And the best trends actually combine a lot. So you think about, PC and software, hardware and software, mobile apps, cloud computing, they all work together. So we're looking for trends that really compound and work together. The second one is a moat. So we all have heard about this moat concept from Buffett, having a barrier to entry to your business, like a brand or like intangibles, patents, scale, network effects. And it's sort of, you can picture a castle, right? The more moats and drawbridges, crocodiles, piranhas, the more you've got in the way, the harder it is to get that treasure, that cash flow in the middle. So that trend aspect is important in terms of creating value and thinking about what technologies can, adopt new products like, ride sharing in the mobile phone, smartphone. For Uber to take off, it really required that. But also that mode is important. So to create and capture that moat. And then the third one is management, and management is really important because they influence, the execution of those trends. And we do have a preference for owner and founder-led companies, but also throw in there like business builders. So we're not looking just for like great products. We're looking for a company that has a structure of going back to mental models, like a process, system, training systems, remuneration, KPIs that will enable people to take risks and solve problems in a better way. So, you think about like someone like an Amazon or Apple, there's just certain businesses where you can just look at it and you go, they have the business building muscle. Like they're always, every year or two, they're always doing something new or trying something. And it's really difficult to really innovate and do that while you're executing your original business. So for them to keep building on top of that is quite extraordinary. So we do look for that. And then the final one is just a return requirement. So we really are trying to be long-term. We try and say, we're looking at over 5 years. And over that 5-year period, we'd like to see the shares potentially double, which is a 15% per annum compound return. So those 4 things, the trends, the moats, the management which influence it, and a certain return requirement, because if you can't, it could be priced for it, and then it's not really worth investing. So that's a quick summary of it.
Yeah. So with regards to how the world is going at the moment, especially given the last year and a half, like how much has that accelerated the change, and like how has your approach maybe differed, or like, what's been the past year and a half, 2 years for you now, really, given your approach?
Where the world going approach has benefited from this environment, because COVID has been horrible, to be clear, but it's also made us re-question assumptions and habits. And so we tend to live life on autopilot with a lot of things. Like, we tend not to change things too often, but lockdowns and all these other situations have created an opportunity for us to pick up new habits, to rethink what we do, streaming, for example, or telehealth, something like working from home for me, for example, was something I never thought I'd really enjoy, but it's given me time to think. And so we've been able to try things that we were probably less willing to try in the past, and that's really helped us with that where the world is going approach, because people have adopted these trends at a much faster rate, and we're seeing things just changing a lot quicker than ever. And as an investor, it's it has been quite difficult looking at the human costs, but there's also the positive of, we're digitalizing a bit faster. There's, people picking up new habits and opportunities. And like, there really hasn't been an environment quite like this. So we haven't really changed anything. I mean, from a portfolio point of view, we did sell some travel stocks early on. But we've generally kept that process of where the world is going, because I think it's actually accelerated and helped us a lot over the last year and a half.
Yeah, fair enough. And you've already mentioned a few international names, but given that the Spaceship Universe portfolio invests globally with a strong focus on the US, I think 80%, was it?
Around 55. Yeah, 55.
55, okay, sorry. How do you approach investing in markets globally versus your home? Because Australia only makes up, 2% of the global stock market. So how do you approach that?
Yeah, so I think you're referring to the 80% global allocation and then 55%. Yeah. So for us, we think about trends. We don't really think about sectors and countries as much, because, I mean, how these things are sort of put together is quite bizarre. Like, for example, technology is all lumped together, but each business has really different drivers. Like Apple's a hardware company and Google's a media company, for example. So we've broken it down into trends instead of sectors, and we've done it in a way where we're not looking at everything, because it's a big world out there, but there's a lot of disruption as well. So like for banks, we don't really spend any time. Oil and resources, we're not spending any time because of renewables and disruption risk there. So there's whole parts of the market we don't look at, and we do go back to that process of looking for trends. For me, the most interesting trends are the ones that multiply, and I think about healthcare, for example, as one. Like, you've got all these genomics, the prices going down, artificial intelligence, telehealth, there's more data out there. Like, for me, that's a really interesting area as well. Yeah.
Is there any other trends that you really caught your eye interested, or maybe underrated?
Well, the metaverse is one that comes up a lot. I wouldn't call that underrated, but that's one where, where a lot of us are locked down in homes, and gaming's been a real social avenue. And then you have all these NFTs as well. And I think that's been a real big area of interest for me, because if you can get it's not every day that you create a new world, right? So if you create a digital world, it's quite interesting. Like you can create a new product and new ecosystem and platform, but if you're creating a digital twin of the world, that's quite valuable. Like it's not just going to be one company; it's going to be a lot, and that could potentially be something that we never quite see before. And things like virtual reality and a lot of these game engine platforms and 3D, it's just getting a lot easier for people to design. And I think, with all blockchain technology as well, people are just delving into this a lot more than they have in the past. And maybe we might finally see that happen. And it's an area I'm really keeping an eye on, because I think if companies can get it right, it's a whole new world, and that doesn't happen very often.
Yeah, for sure. With regards to returns and maybe the pressure that comes along with it, Spaceship's universe portfolio has averaged nearly 30% per annum since it was first funded in May 2018. Like, what's the pressure that comes with it? Like, how do you even approach a portfolio going forward after doing so well? Like, maybe just walk me through it. Yeah, I'd just love to hear it.
Yeah, this is the time for the typical disclaimer. Past performance is no guarantee of future performance. I would just say COVID was quite unusual in terms of accelerating some of these trends. And when we do buy shares, we're looking for 15% per annum. That's what we're looking for. And so we've done better than that, which is great. And we hope to do better than that. But yeah, the market has gone up quite a lot. And when we do try and make those 15% per annum returns, we're going to make mistakes. So our returns could be actually lower than that. But I mean, that's what we're targeting on average. And that's what I would point people to expect, rather than what's happened in the past. Even though that is a good guide, it's more about the process rather than the returns. If you like the process and it makes sense, then maybe consider it. Don't just look at the returns, because returns can change quite quickly. And if you don't believe in the process, then you're not going to hang around. And so for me, I would say to investors, focus more on it's the mental models, the decision making. Like, what are the decisions they're making? What is their process? Do I understand it? Is it simple? Does it make sense to me? Rather than focusing too much on returns. I know it's not exciting, but it's a process over outcomes. Like, always go to the process rather than the outcome.
For sure, totally agree. And in terms of the process, as a fund manager, like, what does a typical day look like for you? Maybe either pre-COVID, now, take with it however you like.
Yeah, it is different post-COVID. For me, what I do like about it, every day is quite different. Like, I try not to get too caught up in market news, but there's always something happening. There's always something you can learn about. And for me, at the end of the day, I actually measure myself from, what have I learned today? Have I learned anything new about my companies, the businesses, any new trends? Have I improved my decision making? Have I learned anything? Have I acted like in a long-term manner? So I'm always trying to think about, how can I improve what I do every day? And a privilege for me is just listening to company management. Like, these people are on the edge of everything. They're investing billions of dollars, potentially new technologies, new trends. And so I'm always reading earnings transcripts or speaking to someone or learning from them to see what they're seeing, because they're the ones who are at the forefront of this. And for me, it's all about learning, and every day is different. So if you like learning, funds management is for you.
Yeah, but I was talking about this mates the other day, and it's a hard balance, isn't it? Because you want to read and keep up with things, but at the same time, you have to sort of try and filter what is actually useful rather than just sort of consuming for the sake of it. So how do you balance that? Or is it just...
That's a really good question. I think that's changed a lot. Like, you look back, 10, 15 years ago, stockbrokers were like the bee's knees, because it was all about information. Like, the information didn't really flow as easily as it does now. Now it's just there's stuff everywhere, podcasts, social media, you name it. And for me, it is about filtering, and it's understanding. It's not just news. Like, news is just news. It's just short term. Like, is this going to help me understand the company or improve my decision making over the long term? And there's lots of stuff you can read, but I filter it. Will this news matter in a year or two's time? And if you use that filter, most things you can throw out. But you do have your own favorite sources for certain areas. Like, you'll follow a certain newsletter from a certain area. You'll have your favorite analyst, and you'll get there over time. But that's a really important thing to do. Just make sure you're filtering the right information. Make sure that the people you're reading are experts in that area, that they do have the same time horizon, and what are their incentives. I talked about the news articles. Like, it's mostly about ratings and readership, and so of course it's going to be controversial. Whereas something that's sort of compounding or working away in the background might not get that news. So you've just got to make sure you dig a bit deeper and try and look at more positive news, because there's always negative news headlines blaring out at you, but there's always something positive happening underneath.
Yeah, so I got to ask, and obviously off the top of your head, if you can, but what are some of your favourite sources of information? Newsletters, blogs, whatever it be, podcasts, anything. Like, what do you find the most value out of?
Yeah, I like Annual Letters by Jeff Bezos. I hope he keeps it up now he's chairman. I thought they're always good. Everyone talks about Warren Buffett. I would say for newsletters, I do like Strict Techery, Ben Thompson. The Information, I think, has some pretty good articles on the tech industry, like sort of just interviewing like managers, not just CEOs, but just from the manager point of view, I think, which is quite interesting. They might normally not get contacted by the media, so I think they've done a really good job from that point of view. And then, yeah, I mean, there's so many great podcasts that I don't want to single out anyone, but there's just, yeah, there's a lot. Oh, and Best Like the Best. That's a great one. Patrick, he's gifted at what he does. Like, you can tell, like, he puts in a lot of effort and he really knows his topics, and I think he does a really great job. And Business Breakdowns, which is related to them, I really enjoy that as well, just breaking down the business within that as well.
Yeah, for sure. In terms of, life as a portfolio manager, has there anything been that surprised you the most about it? Or like, what do you wish maybe more people knew about your role?
I guess what's interesting about this industry is that there are all different incentive structures. That's what surprised me. I didn't realize, how often like an investment bank's more interested in their IPO and getting an initial public offer things. This is a generalization than, the research. So I guess I didn't realize just the amount of conflicting incentives, and like even portfolio managers. We all say we're long-term. I don't think you'll hear anyone who says they're a short-term trader, but you look at their portfolios, they're turning their portfolio over 100% a year. So their holding period is 1 year. And so there's nothing really long-term about that. And so for me, it was quite a surprise just to come in and just see the behavior, but you're incentivized for it. If you get an annual bonus, well, you're probably going to turn over the portfolio every year. If your business makes more money from IPOs, well, you might prioritize that over the research. And so for me, it was just I don't know, an eye opener to the power of incentives and structure, and making sure you're in a structure and you understand what incentives are driving behavior. I think that was the biggest eye opener to me, and just reading research reports, like all of it's about short-term earnings. There's nothing really about the whole product roadmap or what I call that business building model, like what processes are they putting in? Because who knew Amazon was going to launch AWS? Who knew Apple would launch the iPhone? You didn't, but if you knew they had like this process for inventing and learning, and their competitors didn't, well, you can have a vague idea, well, going forward, I'm not sure what's going to happen, but I know if something happens or changes, they'll jump on this trend and execute it quicker than anyone else could. And so for me, it's just a surprise to think that it's very different. I would say what we do is very different from most other fund managers. It shouldn't be, but it is because of those incentive structures that drive sort of short-term performance and activity rather than long-term investing in customers' best interests.
Yeah. With regards to Spaceship, how do you think they're specifically changing, and maybe why did you join them as well, and what makes them different?
I think it's their, that whole approach to, disrupting super, getting people to think about it. Nobody thinks about superannuation, and because it's, 30, 40 years off, it's not your money, but really it is. And I think it's a perfect vehicle for building wealth because you're not tempted to do anything or touch it. And so that really got me interested. And then I think we've done a great job with this, if I can say. The Voyager app, just, having an app, it doesn't seem groundbreaking, but for the funds management and industry, it is, because historically you've had to get a financial planner, you've need a certain amount of money, you fill out these paper forms to invest, you need $500 or $1,000 minimum, and we've just sort of gotten rid of that and made it simple. Just download an app, you can look at the stock profiles, you can look at returns, and you can set up investment plans. Really simple stuff, but no one's really done that well. And so I think that's what makes us quite different. We're just not a typical funds management sort of business. And to me, I'm very mission driven. Like, I talk about it a lot at work. Like, we want missionaries, not mercenaries. It's okay to want to earn some money, but the people who are going to stick around and stick through it, it's like a mission. And they're the ones who are really going to drive the business. And we sort of look for that in our investments as well. Like, businesses that have a mission that can really attract a loyal community of supporters. You build word of mouth, and And the community is just such a powerful thing to replicate. Like you can replicate a product feature or something else, but you can't replicate that community. And if people love your product, they're going to share it. Love's shared around, like it goes around. Like people love to talk about something like some cool experience they've had or something like that. And so we're trying to capture that in our investments and hopefully as a company as well.
To sort of wind back, we mentioned way back about sort of how maybe in schools investing isn't taught, and maybe with younger investors not knowing that much about super. Like, I don't even want to know how many people still have the same super account when they first started with their first job. Like, what do you wish maybe more young investors knew? Or like, if you could teach, I don't know, investing at high school, what would you teach, or what would you focus on, do you reckon?
Yeah, it's a good question about superannuation, because I'm in the industry myself, and you can probably talk to a lot of people who probably don't spend enough time on their super when they work in the industry, and they probably should. So I think it's the problem everyone has. I just think just the importance of owning, like becoming an owner. Like we're so focused. Like I've talked about lenses before. Like we have this consumer lens. We're just bombarded to be a consumer. Like you should buy this next. You should upgrade to your TV. But we're never marketed or told to become owners. And I think that's a real reason why there is a wealth gap in a lot of places, because we're just not taught that way. And it's not taught that you should be an owner. And the stock market is a great path to owning businesses. I just think it should be mandatory, to be honest. And just the power of compounding. Like I talk about learning and investing being linked, because they are. It's about decision making. And if you improve your decision or your learning by 1% a day, that compounding after 365 days, after 1 year, it's nearly 38 times, 37 times that balance. And so it's really important to get started young, because, we talk about Buffett a lot, but, he's so wealthy because he started like when he was 11 or something, and he's still going, he's 90. Like people forget about that. Not only has he got really great returns, but he's done it over a long period of time. Most of his wealth was built after he was like 50 or 60. So yeah, it's really important to get started. And I mean, as a young person, you should still travel and have those experiences, but you should also build that habit of just stocking a little bit away. And then you'll realize after a while, wow, it's quite a meaningful amount. So for me, it'd be, just going back to thinking about mental models, thinking about the lenses, thinking about it, when you're shopping, think about it as an owner. When you're out shopping, like for me, I actually like going shopping now, because I'm looking at, like where are the biggest lines, like what's going on, like what are new people buying, what habits are being built. And so it's just, having that owner lens and mental models and power of compounding would probably be the three ones I'd talk about, rather than some of the other things we learn at school, which I'd say, but I probably can't even remember. Like with my kids, like, why are we learning this? I'm like, oh, you just use a calculator for that. I'm a bad example.
I think we were the same. We learned, just not much useful, but no, it is what it is. But sort of the Peter Lynch model almost as a consumer. You're looking for has there been any things like that have been real big influences, maybe him or like any others, or?
Yeah. So you've picked up on that, and so big influence on me is Peter Lynch. I think it's a great investing book to start out on, because it is quite simple, and investing can be simple if you make it. Like there are no points for extra difficulty. Like this isn't gymnastics, or we're not diving, or you can keep it simple. And I think people do have that knowledge. Like sometimes the way we shop can be counterproductive. Like if we're buying out of excitement or just out of boredom, it's not great. But like the way we buy a refrigerator or car is a great analogy to investing. Like you're doing your research, you're budgeting, you're looking at competitors, you're looking at relative valuations, you spend a bit of time on it, even planning holidays, right? Like, so you can use some of those skills to invest. And so for me, like the best companies are products that and use, and that people love, because that word of mouth people promote. And so I'm always going back, like what is a real great product, and what is a great process, and what business out there would could increase prices, and you potentially would be happy to pay. And so you can do this very easily. You can go down your bank statements and see where's my money going, and you can see what is must have, like what is unique. Like some companies just have that mind share. Like I'd say Disney, if you're going to theme park, Disney just has the mind share, like, or Nike in shoes, like, or Uber. Like just some companies just have this mind share that is extremely valuable, and it as a consumer. But as an investor, like, ride sharing is only 3-4% of transportation. Like you think it's a lot bigger than what it is, but it's not. So you can sort of bridge the gap as a consumer and thinking about it as an investor point of view. It's the next step up, but I think that consumer knowledge and that foundation is really important to becoming an investor. And it's all there. It's just that next level we've just got to build up and work on. And, it just takes time, like everything, like every other business or job, it's like an apprenticeship. It takes time and you'll work on it and you'll get there. But yeah, it is there for everyone, I think, which is great.
Yeah, and I think, same thing with consumers. I think they're so early in on it as well. Like, I don't even want to think about the amount of times I've seen a company start making moves early, or you notice a trend, but you don't really actually make a move into investing, or even just further research. But yeah, you sense it, I think, a lot earlier as a consumer half the time as well.
Yeah, and we make things difficult. Like Afterpay is like my favorite. Like it was just everywhere. But like investors would talk about, oh, it's doubled, it's gone up too much, or it's it's expensive short term, which it was. But it's about the engagement and lifetime value of the customer, and it was sort of how you thought about it as well. They're not only a payment platform, but it's marketing, and that's why companies pay extra for it, because it's a driver of traffic. And so, yeah, your best ideas just come from the internet and seeing new adoption. As you say, it's quite simple. It seems too simple at times, just like Netflix as well. You can think about all these examples. You can think, wow, people really talked about these services and shared it around, but we'll put off because the shares doubled or it looked expensive on a 1 year basis. And so, yeah, we just got to make sure we look at like the actual adoption, because it's probably a lot less than what you think. Because depending on your crowd, if it's more younger people, like the younger people will adopt it a bit earlier, and then other people take a bit longer. So it depends on who you talk to, but the adoption rates could actually be quite a bit lower than what you thought.
Yeah, no, that's a great point. And then, yeah, I guess getting in is one thing, and then holding throughout, I guess, through these growth stages. Like, how do you view holding through volatility or deciding when to sell? Like, what's your views on that? Just walk me through it.
Oh, that's the hardest part, isn't it? Knowing when to sell. I mean, that's why it goes back to make sure you're buying right. And so you're buying, make sure there's a moat and you're in it for the long term. For me, I try to imagine if it, like that framework of the VC, like if I was a VC investor, what would I think? And Afterpay was a good example because it's extremely volatile. And we were quite lucky, I think, as investors in Australia, because it listed, I think, maybe 2 years after it was in business. Couldn't get VC funding, so it listed quite early. And so I always think to myself, like, if this was a private company or if this was VC funded, would I want to own it, and what would it be valued at? And so I'm not always looking at the share price. Like, I'm looking at the market cap, which is basically made up of the number of shares outstanding times the share price. And Afterpay was valued, like I thought if it was private, it would be valued more at certain times of its life. Not lately, because it has gone up. But yeah, I try and think of it from a point of view as like, if I was a business owner, what would I think it's worth? And if you look at some of these financial metrics, say like an Apple, and I've made this mistake of selling it in the past, but if you just look at the financial metrics and the products and what they're doing, you would have never sold it. Like, as a business person, like if it was a private business, you would have never thought of selling it because you're looking at all the metrics, everything's going up, but because it's listed, you'll see it, oh, I think it's gone up too much, I might just sell a little bit, or, oh, it's down 30%, oh, the iPhone cycle's over, or whatever. Like, you'll come up with all these other reasons to sell it. But if you owned it as a business, would you sell it? Like, is there anything structurally, do I see that decision making has changed? Do people still love the product? And just making sure I stay there, because I think having a really good management team, probably, if you're going to my big mistake, it's underestimating management teams. And like, a really good management team will do things you could never imagine. Like, I think back to Netflix, and that's probably personally my biggest mistake, just in terms, because it's gone up so much, right? Like, you can lose money and lose 20-30%, which is horrible. But if you don't buy something, or you sell it and it goes up like 3, 4, 5, 10-fold, that's massive. And so for me, it was like, I owned Netflix when it was a sort of that DVD provider, right? Like, not much of a moat, like, great service, but I didn't really think it through, like, just his process. He knew this from the beginning. Like, he named it Netflix. Like, he named it Netflix while it was still a DVD company for like 10 years or whatever. And he knew in the back of his head he had to blow up that business and switch to streaming. But I think for me, what I learned from Reed Hastings and Netflix is just the timing of the technology waves. Like, he timed it perfectly. Like, he launched Netflix just as DVDs got cheap. Like, I mean, VHS through the mail, if you remember that, that wouldn't work. And then they launched streaming when broadband was at a certain level. And then they launched original content when they were global. And so that made a lot of sense for them, because the original content they could have the licenses all at once. They didn't have to put it in each region. They could scale their costs across not just American households, but globally. It's like, how can you compete with that? So for me, my biggest learnings have been just understanding the process and structures that management use. And that can be quite hard to see from the outside. And so I've just got to make sure that I course adjust and go, okay, like they are showing it, even though the shares might have gone up. They've really got this culture of business building, taking advantage of opportunities versus their competitors that could be really valuable, and just valuing that rather than just the product set. And
I loved what you said about thinking about the whole business. It would be cheaper, but it also probably helps you on the flip side as well. If you're, maybe it applies to more my mates and stuff, but if they're thinking of taking a risky bet on a company, but if they thought about buying the whole thing, maybe they wouldn't, because it's just too much problems. Whereas if it's just buying a couple of shares, maybe they're willing to take that gamble. You know what I mean?
Yeah. It's like, for me, like Apple for me isn't like a couple $100 stock. It's a $2 trillion business. So I'm struck. We own Apple, but I'm like, are we finally at the stage? And I'm holding on because they do have that business building culture. Like I laughed at AirPods. I was like, great. But, that's like a Fortune 100 business on its own. And so it's quite extraordinary to me if you do have that culture, just to, even though it might seem expensive, just to hold on, because like you just can't know what they'll do. And it's very rare to have businesses like Amazon, or I'll throw in Tesla. And there's a few businesses like that just have this culture of just executing and taking advantage of those opportunities. And for me, like I would say don't check the share price too often, like check the business fundamentals as much as share prices. And so if I do have Bloomberg, like I'll look at the chart, but I'll also have a chart of earnings or revenue along with it. And you can see how like consistent the revenue might be. The stock price is all over the place. And over time, there is a correlation. And so for me, it's just, if you're checking the share price, make sure you just check the business fundamentals as well. Make sure they're going up in the same region, because a stock that might go up might seem expensive, but it's doubled, but sales are up, more than double, or it could be cheap. And a stock that goes down 50% could be expensive because the profits are down 70%. You know what I mean? So it's just tying it back to the fundamentals and not just looking at the share price in isolation, which is very easy to do. With Robinhood and everything that's going on at the moment, it's very easy to get caught up in the share price. But look at the business fundamentals as well.
Yeah, for sure. Totally agree. To move into my final round of closing questions, what do you think is the most undervalued life experience that university-age students don't give weight to? Like, what's an underrated skill or an experience that you think maybe they should have?
Yeah, I would just double down on mental models. Like, there was never like a Decision 101 class. Like, they're a sort, you'll learn something from like economics. You'll know about supply and demand, which is helpful. But that's just one mental model. And so for me, it's just being multidisciplinary, and it's hard to get that out of school and university. So it's just having a varied amount of friends and looking at podcasts. I'd also say travel. Hopefully now that we're opening up, we can travel, because I think that's going back to the lenses that we wear as, consumers, owners, and different industries. Like, I think when you travel, you just get a different perspective on things. I think you learn a lot when you're young. You learn a lot about yourself, how capable you are, like going to countries with different languages and different things you take for granted. You go, oh my gosh, it's so hard to go out and like, oh, I got a barter to buy everything, or, so it's, I think you do learn a lot as traveling, and hopefully we can get back to doing that, because, I think you come back as well with a different lens, and, you appreciate home a lot more, and you just open your eyes to the world out there. Like it's we're very lucky, I think, to be in Australia. So I think it's very important for young Australians to go out and travel, because we've got it pretty good over here.
Yeah. Oh, totally agree. Yeah. I was the exact same. So lucky over here, didn't quite realise, and I was probably a bit of an a-hole. But then once you go overseas, whole different world. Character building as well. You put your passport through the wash and you're trying to deal with embassies. It's and you get a few good stories out of it. But
yeah, exactly.
Have there been any maybe books or like classes or even experiences, travel experiences, that have been influential in shaping your worldview? Like, what's been the most impactful, do you think?
Double down on the Peter Lynch book. I think that's a great one to read for first-time investors. For mental models, what opened up my eye to that was Poor Charlie's Almanac. I don't know if you've read that one, but it's a bit of a coffee table-like book. But yeah, that's a great introduction to thinking about, what's really driving decisions, because there's, the rational decisions, and then there's the emotional and the psychological reasons that we do things. Another non-investing book, which I thought was interesting, that gets talked about a lot, and rightly so, is Sapiens. I think that's by Yuval. Like, that's a great book, because for me, it just shows how we progressed as humans through history, and how we make up these imagined realities. Like, what is a company? We just made it up. What is money? It's just something we made up. And so we've just made up a lot of these things to make us work and cooperate together. And it's really influenced the way I think about investing, because investing hasn't been around that long. Companies haven't been around that long. Stock markets aren't around that long. But we're still wired for this lizard brain that we've got, from the Stone Age, like the Flintstones. And so, like, whenever there's a market correction, we'll panic because we don't want to lose money. A fight or flight response kicks off and we'll go off. We don't think in probabilities. Like, if there's a rustle in the bush, like the people who ran away survived. People who thought about it, it's probably not a lion, I'm not sure. Most of them are dead. So, like, we're just, like, how we've evolved as people is not helpful for our investing. And I understand why it's hard, just because those biases just kick in, like that fight or flight kicks in, and it just makes it difficult. So just understanding that, I think, was a bit helpful for me in that framework. So yeah, I really enjoyed Sapiens and whatever he writes, Yuval.
Yeah, and I think it's been very relevant in the last year. I've mentioned this before, but same thing. If everyone believes something's true, then it kind of just is. Like, it was kind of hard for me to wrap my head around sometimes. Like, you just like, if it doesn't match fundamental, like with GameStop and stuff, when that sort of started kicking off, I'm like, I don't believe it, but if everyone else does, then I guess it sort of is. You know what I mean?
Yeah, it's self-fulfilling prophecy. That's the tricky part about the markets, and what people talk about hedge funds. What I've never liked about them is, like, there are good hedge funds, but when they're short selling, they're creating a negative feedback loop that's hard to get out, and they can destroy companies. And so we've seen a few companies get destroyed, but now we have this opposite Robin Hood effect, where people are supporting companies, buying the shares so the company can raise money, and then it's more likely to survive, as you say, like GameStop and AMC. And so for me, those companies shouldn't be trading where they are, but people believe in it and they want to support it. And I think that's a great sort of counterfactor to short selling sometimes. Like, if you really want a company to survive, buy the shares and support them in raising money. But it's not a great investment style potentially, but it is a counter to short selling. So I think it's quite interesting to see that phenomenon. And yeah, you see it in companies themselves, like Amazon. If people believe they can allocate capital better, then they can raise capital at a lower rate, and that affects the fundamentals. The stock price goes up, that can help you attract better people. And so you do see self-fulfilling nature in markets as well. And I think that's an interesting to point out.
Yeah, and there's something, like, I used to work at a quant fund for a little bit, and that was based on momentum investing. And same sort of thing. I don't typically believe in momentum investing, but if everyone else believes it's true, same thing, it's a self-fulfilling prophecy and it works. So it's like, well, yeah, what can you do? So.
Yeah, it might not shortcut, so you got to be careful if you're shorting sometimes. Yeah, so it makes you very careful. Like, the market is supposed to, George Soros talks about this. Markets are supposed to reflect the fundamentals, but sometimes the market can affect the fundamentals. And so we see it, like, during recessions, like the stock market will fall and then we're in a recession. Well, we're in a recession because people lost money and they're not confident, so they're spending less. So it's sort of, it's self-fulfilling both ways.
Today, where do you think the biggest opportunities lie for youth? Like, if you were 18, like, where would you be spending your time? Obviously, maybe travel, like we mentioned, or like, what else would you be doing, do you reckon?
Oh, for me, what's exciting is, I hinted before, is healthcare, like the convergence of healthcare and tech. And I look at the US, like, healthcare is 17% of US GDP. Like, it's material. And you look at advertising globally, it's a bit over 1%. And you're just seeing these $1 trillion companies created out of making advertising more efficient. It's like, how did we go there first? But yeah, well, we're here. So I'm very interested in healthcare, just the digitization of it, DNA sequencing. Like, I'm blown away by these messenger RNA from, BioNTech, that, vaccines have historically taken, 10 years plus, and like, it was all sort of figured out in a year, which is amazing. So for me, if I was a young person, I would, just get in that field of biotechnology, just because I think there are just going to be some great breakthroughs. Like we can computer code zeros and ones, like we can code like biology, A, T, C's and G's, and just hearing some of these companies talk about it, it's something that at Spaceship we're probably going to focus on a bit more. But a lot of these companies are still at very early stages, but I just think it's a super exciting area. Like, if we can really get that area going, like if we can digitalize healthcare just a little bit more, just the health outcomes, longevity, the efficiency, and then, just investor returns as well will be potentially great, because healthcare has a lot of barriers to entry. And there is a reason why it's taken so long, regulatory, etc. But for me, it's just a really interesting area, just given the confluence, talking about a multitude of trends, like the cost of DNA sequencing. Like, it's just, the amount of funding that's been available for me. It's just, a very exciting area, I think, to follow.
Yeah, no, I love that answer. And yeah, same thing. If more people get excited about it, then it might become what it's destined to be, I guess.
Yeah. And I'm so glad we have these great scientists, like, just to get these discoveries, because a lot of them work in the backgrounds for years. And just to see it all has just been amazing compared to, what we've had to deal with. If we didn't have the vaccines, like, I shudder to think, like, what this conversation would have been like. Yeah.
For sure. And my final question, like, what plans or vision do you have for maybe, 5-10 years, like, really extrapolating it out? Like, what are you most curious about going forward besides the healthcare bit?
The healthcare is interesting. And also the metaverse, because for us, like, the companies we own at Spaceship are already interested in it. So I feel for us, it's like an option, free option. So we own NVIDIA, who is a leader in graphic process units, which is, they're really good at gaming, right? Because they parallel compute, each pixel, all at once on the screen. It turns out that was great for AI. And so what they're doing is they call it the Omniverse. So they're basically building like factories, like digital twins of factories, and training robots in the artificial world. So then when they're in the real world, they're all fully trained. I was like, oh, wow, you're training robots, simulated robots. So for me, like, they already have a core business, but they have that. And then there's a company like Tencent, right? Like, in social gaming, like, I think their background in gaming, social, and payments, they would be really good in a gaming metaverse. And then Facebook's there sort of as well, talking about it. They're the largest social network. Well, can they replicate that in a digital type setting? And so for me, it's really interesting because, like, they already have their core businesses, but, like, they have this optionality on the metaverse, and they're all building into it. And so for me to see these great companies invest in it, it suggests that there's something there, and it's something I'm pretty keen on looking at. Just following, I think, over the next couple of years, because it's low risk for us, because, I like the trade-offs there.
Yeah, exactly. The tail rewards from all the optionality, so that's perfect. So, yeah, thank you, Jason. Thank you so much for today. I've had a blast. So.
No, it was a great chat. I can see you're very curious, and I'm sure we'll keep chatting as well. So, yeah, thanks for your time.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Either way, links to all content mentioned will be in the description below. Also, be sure to sign up for my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on your time invested. Sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.